Good afternoon and welcome everyone to today's webinar. This is the second of a series with today focused on the subject, strong farms start with smart spending. So just a quick note that today's session will be recorded, so any questions and comments will be publicly available. So again, today it's meant to be informative and educational, so no advice is provided. Q&A is at the end, but please place any questions in the Q&A section throughout the presentation. So we'll try and answer these later at the end. If you do happen to place your question in the comments, we'll try and find it, but no guarantee that we'll see it in time. So try and use the Q&A section. I just want to thank you all for joining today. Again, we've had an overwhelming response and we hope to continue to fuel your appetite. We'll remain high level through these topics, so please don't get overwhelmed by some of the detail behind this conversation. There'll be a short survey at the end also, so if there are any focus areas you'd like us to drill down on, please complete the survey and that'll assist us make refinements for the future. So regarding today, I'd like to start by setting the scene by reviewing some historical data through the Farm Debt Restructure Office and the Queensland Rural Debt Surveys. I'll then hand over to John Gillespie, so he's going to take you through a quick recap and then develop some further concepts on why strong farms start with smart spending. Again, our intent, we're trying to stay high level, but pending your feedback, we do have the capacity to shape some specialised content for the future. Quick one, introduction to us. We're a statutory authority providing specialty services predominantly to the Queensland Government. Many of you are aware of our concessional lending and disaster support we provide across Queensland with 11 of our regional area managers. So if we do trigger some investment and expansion ideas for your operations, please feel free to reach out. Our contact details are available via the website. So to get cracking on my section, recently I prepared a presentation for lenders and mediators going back over 30 years of the Queensland Rural Debt Survey. So we all know that there's been a significant increase in land values, but what did our borrowings and number of borrowers look like over this period? So as you can see from this graph, the average real debt in 1995 was a fraction under 250,000, and that has grown to almost 1.8 million per borrower in 2023. So that's over 7 times the value. When I looked at the ABARES data for Northern Australian beef enterprises, so that's Queensland, Northern Territory and the west and the northern tip of Western Australia, land values grew from $739 a hectare to over $6,782 a hectare. So that's over 9 times increase. Question is, why have I been investigating this? It's because I expected to see that with these larger debt levels, I thought there'd be a consolidation with a smaller pool of borrowers. So your large corporate entities, high net worth consortiums, and large family operations. But surprisingly, the number of borrowers has remained pretty stable for the period. So starting at 16,320 in 1995, compared to the 16,799 in 2023. So yeah, amazingly very stable. The Farm Debt Restructure Office captures several pieces of data through the Farm Business Analysis Program. So every couple of years, I calculate a retrospective ratio I call the Farm Debt Restructure Ratio. So, it's not going to predict the future, but it actually gives us a bit of an insight into the past. So by dividing the average earnings before interest and tax by the average farm liabilities of producers, we get a basic understanding of a farm's capacity to meet its interest requirements. So by comparing this figure with the small business interest rates from the RBA for the same period, we get some understanding of how stressed the market was. So to interpret the graph, anytime the blue line is significantly above the black line, it suggests there were good times, and the reverse would also suggest tough times. So when the line stays in the neutral or positive area, we do not see significant inquiry because basic needs are being met. And I caveat this though, it is not a sign of strong business performance, and hence my appreciation for the support from John's knowledge and today's topic. You'll also see the yellow line in this graph, which depicts the average margin a small business pays above large businesses for their credit. So in other words, large businesses have enjoyed an average of 2% discount over small businesses when accessing credit. So this is pretty significant when competing for the same piece of land based on the same return, but vastly different income and cost bases. So QRIDA's Farm Debt Restructure Office offers the Farm Business Analysis Assistance Program for those primary producers currently being impacted or concerned about the direction of their enterprise. So with that in mind, I'd like to introduce to you again QRIDA economist John Gillespie. As noted previously, John has over 40 years experience and has developed a suite of material focused to improve business management, decision-making, productivity and risk. So without further ado, John, I'll hand over to you. Thanks very much.
Okay, so can everybody see my screen? Hope you can.
Yes.
Look, thanks for coming along. I really enjoy doing these sessions, and I hope you get as much enjoyment out of what we're presenting today as I do get in delivering it. So I suppose the really important thing that we need to consider from our perspective is what we talk about in terms of strong, smart spending. And some topics we're going to look at today is cost allocation, process mapping, and a lot of people don't consider revenue as a cost, but if you lose revenue, and then obviously it is a cost, some ways to measure efficiency, look at how we can improve the investment we have in our machinery, and of course, lastly but not least, the cost of finance. These are all costs that we incur from a business perspective, and unless we can improve them, then we're going to really struggle in the long-term future. So just out of curiosity, this is a statement by Andrew Carnegie. Now, he was a US steel magnate. He started with nothing back in the mid to late 1800s. And he always said that what's costs and profit will take after themselves. And I really can't emphasize that enough, because costs are critical. And as an industry sector, we are price takers, and it doesn't matter how hard we try to make that change. We're effectively dictated to, in terms of the price of our product, by our customers. A lot of other industry sectors don't have this issue, but we do. So the only way we can improve our profit margins is by reducing costs, improving the quality of our product, or increasing price, or increasing the volume of product that we sell to the marketplace. So I'll just revisit that. In a webinar we ran last year on measurement equals productivity and profit. So the first one, there's only 3 ways to make more money. There's increased sales. Sometimes that's difficult considering that we're exposed to a lot of climate risk, and we're also exposed to a lot of international trade. We can reduce our overheads, or we can improve our profit margins. Now, the way we can improve profit margins is either increase the price of what we sell, and that's by increasing the quality of what we sell, or the volume that we sell, or reduce the cost that we are required to input to actually create that product. So just a clarification here, I always talk about overheads. Overheads are fixed, indirect, or operational costs, but also talk about direct costs. Now, sometimes you hear direct costs referred to as cost of goods sold. Some financial packages all talk about cost of goods sold. Other people talk about variable costs. These are direct costs. I find direct cost as a very simple way of putting it, because defining direct cost is for every unit of output, you have an increased, comparable increase in your cost of the output. So, for example, you increase the area of farming, you increase the price you're paying for fertiliser. So in terms of productivity, it's really important we understand that. Productivity uses inputs such as money, labour and materials to produce output such as revenues, products, kilos per hectare, or kilos per beast, or the services that we do. And that's how we convert the inputs, dollar inputs we have into the dollar output. We need to improve our efficiency to effectively improve the ratio of inputs relative to the output that we do. So there's a number of efficiency measures. There's capital efficiency, in other words, the money that we use. There's labour productivity in terms of the amount of hours that we spend doing the jobs that we need to do. There's energy efficiency. Now, that's quite a topical thing at the moment, considering the cost of energy. There's operational or material efficiencies. That's relative to the amount of inputs. So in other words, if we increase the kilos of fertiliser we put on our paddock, do we get a corresponding increase in production? And there's an interesting chart that I've done some work on just recently that actually says there's a point where we don't get any more increase in performance. There's process efficiency, and of course the last one is environmental sustainability. And it's really important that we understand how we look at these efficiency measures, because they all relate directly to how much money we make. So the only way that we can actually start determining our efficiency levels, we need to look, firstly, know what our business is actually doing. How is it performing relative to inputs and outputs? And the easiest way to do that initially is to look at your financial KPIs, your financial ratios. They're your gross margins, your overheads to sales, those sorts of things. We need to calculate those, and we need to compare them. There's a couple of ways to compare them. One is internally, in other words, from year to year, and to see how we're performing over time. Or alternatively, which is a really good measurement, is to benchmark ourselves against our neighbours or our peers. This is a really good measurement because it allows us to say, okay, well, who's doing better than me and why aren't I doing as well as them? And be able to understand that is critical to improve our performance, reduce our costs, and basically make more money. So in terms of ways to improve, this all comes back to cost management. So firstly, the thing we need to do is reduce unproductive assets. This costs the business in maintenance. To give you an example, we had 3 tractors when I was chasing cows and sheep for 30 odd years out in Western Queensland. I collapsed that to 1 because the 2 other machines that we had were costing us money because we had to maintain them, we had to look after them, and a machine that wasn't sitting, oil seals dried up, and you end up with a higher maintenance cost. Transfer capital into more productive assets. So you might have an asset there that's sitting doing nothing. Sell it, get rid of it, replace it with something that is producing more and returning some revenue. The other one is to look at cost reducing efficiencies. How you can do that? Look at the way you manage your time. Look at the way you improve your productivity and performance. Obviously, reducing your interest bill is a really important one. And as Dan just said just then, the debt levels are increasing quite substantially. So therefore, we're going to have to manage our interest bill really well. The last one, which aligns to reducing unproductive assets, and that's consolidate those assets to put together to actually improve the way we perform. And lastly, which is probably not as relevant for a lot of agribusinesses, but reduce inventory. Now, an interesting thing here, when I did some work a number of years ago with a piggery, 61% or 63% of our total inputs was feed, and a significant proportion of that was grain. So what we did is I did a whole series of numbers about, was it worth our while to buy grain on the spot market and hope that we were able to secure grain at a price? Or alternatively, we looked at buying 12 months worth of grain at a lower price and stored it. In this particular instance, it was actually cheaper for us to store the grain because of the premium that we had to pay as the grain reduced in stock. So we need to look at that. That's really important. Sorry about that. I've got a dog barking. So the other thing that we need to look at, and I think this is really important, quite often we have a situation where our accountants put us into certain areas where we allocate costs. Just excuse me for a second. Sorry about that. Dog was playing up. So in terms of cost allocation, quite often we see our accountant deliver our financial statements like this. So we have cattle, gross profit, fuel rebates, millet returns. Then we have working expenses, and the working expenses will include I do apologise for that.
John, we're actually going really well. We can't hear any of that at all. So
Oh, really?
we can hear you
Okay.
fine.
Can you hear me? Can you hear me?
Yep, you're perfect.
Oh, good. Okay. So in terms of working expenses, a lot of financial advisors usually start with A and end with W. So we get our expenses starting with accounting and ending with wages. When we're analysing our business, this becomes really difficult to determine whether our financial and our production performance is aligned to where we want to be. So what I suggest that you possibly look at, and even if you don't do it from your financial statement, do it internally from a business perspective. So the suggestion that I have, and a lot of software packages I've used Phoenix in the past, I've used Mile, I've used a number of other financial packages, and they all have the ability to be able to break our enterprise analysis down. So for example, you have an enterprise, which is jobs, and I'm using quick Mile here. So enterprise is jobs, so cattle breeding, backgrounding, fattening, stud, wheat, sorghum, chickpeas, hay. Then in each of one of those allocations, we have activities. So for example, in cattle breeding, we might have preg testing. In cattle fattening, we might have forage cropping, or wheat, we might have fertiliser. This allows us then to allocate cost relative to the enterprise that we're operating from. Now, to give you an example, I did a lot of work with a business down around Armidale a number of years ago, and we were looking at how to improve performance from their business. So we looked at gross margins. He had a significant amount of data, and we were able to identify which particular enterprise was making more money. And it then allowed him to focus on those particular enterprises that the margins were better and he was making more profit. So that's the sort of area that we need to look at when we start working about how we're going to improve our cost and our performance. So I would suggest, if possible, have a look at your financial software packages and see if you're able to align that, because breaking down these costs is really important, because you can then determine your gross margins for each one of your enterprises to work out which one's making you more money. And of course, you do exactly the same thing for sales. So if you've got the business that I'm talking about, they had cattle, they had a backgrounding operation, they had fat lambs, they had a merino wool operation, they had a hay operation, and they also had a forage crop operation. So we were able to break that down in terms of sales from each one of those, and we were able to allocate cost relative to each one of those enterprises. That meant that I was able to determine exactly how much each of those enterprises returned to his business. So how it works. Of course, productivity will reduce costs for each input unit of output, and that equals more money. There's no doubt about that. So to achieve productivity, a business needs to know, obviously, what the unit of output, kilograms per animal, kilos per hectare, tonnes or grain per hectare. Again, it's really important that we're able to measure and calculate this so that we can really determine and drill down into where our business is making our most money. Again, we need to look at our units of input. You know, how many hours that we do. So for example, when I was farming out in Western Queensland, I would actually calculate the machine, the number of hours, clock each hour that we spent working in each of the particular activities. So for example, it was chisel ploughing, or it was scarifying, or it was tilling, or it was planting. I would then allocate the kilos of fertiliser that went into each one of those per hectare. And I also allocate the amount of fuel that I used per hour. So I was able to determine exactly how much it cost us per kilo of grain that was returned. And that comes back to the next dot point, what it costs to produce each unit. So if you're able to measure that, it then enables you to be able to say, okay, well, I'm spending too much money on this. Am I able to maximise the efficiency and return more money? And again, just to give you a little bit of a technical speak, when the cost of your input, each increase of the cost of your input is equal to the increase in revenue, that is when you get the profit maximisation. It's called when marginal cost is equal to marginal revenue. Don't worry too much about it. If you do your numbers, you'll actually see that point without having to go through that technicality. So next steps. And these are really important. We have to get ourselves to a point where we're going to make more money. So the first one is around time management. Now, this is a very useful little matrix, because what it says you look at the work that you have to do, firstly from an urgency perspective, and then from an importance perspective. So if it's unimportant and not urgent, don't worry about it. scrap it. I did some work with a guy a number of years ago, and he always said, for each job that you do during the day, allocate a code to it, A, B, C, D. A is really important and D is not as important. And every time you got to a job that you had to do, tear a strip off the list until you got to a point where you couldn't read your list. So if it wasn't important, then and it was still sitting on your list, well, then you didn't need to worry about it. So effectively, when it's really urgent and it's important, then that's where you have to basically drop everything to do it right here and now. Examples of that are if you're suddenly confronted with the fact that you've got a fly wave or a worm burden, there's not much point in fixing up the fence if your sheep are dying. So the way to improve the efficiency of what we do, this is a process map, and this is something that I'd done a number of years ago. And this process actually looks at jetting sheep. Now the red box here is a common process that we have to do when we're going to jet a mob of sheep. So firstly, we obviously have to fill up our tank with water. We have to mix it. We have to make sure our equipment's all working. So effectively, the whole way through here, this is something that has to be done regardless. Now, when I first started chasing cows and sheep in Western Queensland in the mid-70s, we used to do it the old-fashioned way. We took a hand wand, two of us hopped in the yard, we put 800 or 900 sheep in the yard, and we hand jetted them. So effectively, this is the process that we did. So we started by spraying the head. We started running down their back, their crutch, their pizzle, and then we went to the next one. So then we started back up here. Once we finished jetting that particular race, we had to empty it out. So then we let them all run out, and we started all over again. Now, doing it that way, we were able to do 800 a day for 2 men or 2 people. I decided that that wasn't good enough. So we looked at a number of automatic jetting machines that were floating around at the time, and some of them were very effective. They got through a lot of sheep, but some of them ran through so fast that effectively they didn't get sprayed, and others of them got stuck in the machine and got so dripping wet that they covered that water was just running out of them everywhere. So I decided that we needed to make some change. So I embedded a machine that did this same process, but what it did, we only had two activities. Basically, we loaded the sheep in the yard and we pushed them through a conveyor belt that took them through a spray race out the other end. So we went from 800 sheep an hour a day to over 1,000 an hour. The best we ever did was 1,400 sheep in 1 hour. So as you can see, 800 to 1,000 an hour. That's an amazing increase in productivity. Now, that's all very well. And what does it mean to us as a business? Well, this is what it means. I actually calculated the amount of time that it took me to do all that work. And this is what it cost, labour cost per head per day, 63 cents. Once I invented that machine, that's the time it took, and it was 6 cents per head per day. That's an amazing improvement in efficiencies. These are sorts of things that we have to look at to improve the performance and the way we do things. And not only did it improve the performance in terms of labour cost, but also meant that where it would take us 4 or 5 weeks to go through our flock of 18,000 sheep, we're able to do that in 3 or 4 days. So it obviously minimised the number of our losses, not only with the number of sheep that died, but also the reduction in our wool value. The other one that we need to look at is resources, inputs. What does that mean? So inputs are those things like labour, fertilisers, fuel, those sorts of things which we use when we input into our operation to create an output of some sort. So we need to focus on how we're going to reduce those. So it looks at, you can do that through some research. To give an example, I did a lot of work in genetics a number of years ago in sheep. It takes a long time for genetics to show any real improvement. But we were looking at how we could use the genetics to improve our performance. And we were able to reduce our micron by 2 micron, but maintain our fleece weight across the flock at 6 kilos. Now that meant a huge amount of money in terms of returns for our business. When we start looking at reducing our inputs, we can include it across all of the business activities. So in other words, your direct and overhead costs. So how can we reduce those costs? For example, fuel is another good example. Sometimes we have an old machinery that's inefficient and uses a lot of fuel. Maybe we need to think about upgrading it. There's opportunities out there to invest in better equipment, to more efficient equipment. Again, electricity is another really good example where we can improve the value of our inputs to maximise the value of our outputs. And it can be used across all types of enterprises. So we need to worry about whether we're just looking at cropping or beef. We can look at whatever enterprise we're operating off the property. The other area which is really important, and this is some work that I've been doing just recently, looking at how we improve the efficiency of our business and how do we measure that. Now, don't worry too much about the acronym. It's quite often called frontier analysis, but effectively what it does, it looks at the businesses from an input perspective and calculates how efficient that is relative to the outputs. Now, this is a really useful tool because it can be done over time. So if you're making some strategic decisions to make a change to an enterprise or operations, you can actually measure that over time. So starting with year 1 or year 22 or 23, 24, and you can see how that improvement's done over time. The other really important one about it is you can actually get a group of you together in a region and say, okay, we want to measure our efficiency as a group. How are we going to do that? And it's a very, very useful tool. It doesn't take a lot of effort. Referring back to the earlier slides, you have to have the data to be able to input to be able to get the output. So the good part about this, it can be across multiple sites over time. It can be with animal or cropping systems. The most important thing that it uses, it measures labour, material and other inputs, the units that are used, against profits and benefits. And just to give you an idea, this is an exercise that I've done a little while ago. As you can see, this one here is over a 5-year period. It looks at actual income, it looks at actual wages, vehicle costs, and actual material costs. What it does, and when you look at this column here, this is the efficiency level which it allocates to each of those rows. So effectively in year 22, the business was operating at 84% efficiency, but the really, really important part is it's obviously moving up and better because the 2026, it was 100% efficient. Effectively, it's improving productivity. But the really cool part about this particular program, it tells you exactly how much you have to reduce or you have reduced your inputs relative to the outputs. So here, it says that in this particular case, vehicle use has to reduce price by 19%. In terms of material inputs, it says between the first year and the last year, there was a 45.3% improvement in performance. This is where this tool is really, really useful because it actually measures specifically what you have to do to improve. If you get as a group of you together, you can actually show how much there is required to improve across the group. It's a very, very useful tool, and I use it a lot. And I would encourage a lot of people to consider using it. Now, this is just as it's charted. And DMUs talk about decision-making units, effectively their individual businesses. So here, in this particular case, these businesses are business best practice or operating at the best of the group. What we find interesting here is that this one here is actually operating 40% less efficiency than the top best in the group, and all these others have reason to improve. And as I said, if you want a group of you to get together, have a conversation with us, and we can possibly look about saying how can we look at benchmarking a group of you to see where these improvements can be made. Now, obviously, as you can see, a 40% improvement in performance, basically that's a 40% improvement in profit. There's no ifs, buts, or maybes about that. That's what it is. So and because it came, and I'll go back, and because it looks at the actual numbers, as a group, you can say, well, I need to improve or reduce my costs by 45%. And that way you can actually measure what's your improvement, and you can go back to your business and say, okay, well, if my material use might have been fertilizer, am I using too much fertilizer? Or am I using fertilizer in the right way to maximize the yield? So the next one we look at is management strategies and plant and equipment. And here I see a lot of businesses acquire equipment which is probably over or underutilized. So they're overutilized, they might buy themselves a very, very big four-wheel drive, but they might not maximize the use of that, which is an interesting concept, because when you think about it, if you spend a lot of money on a piece of machinery, that's a sunk cost. You can't use it for anything else. You can't use it to innovate or diversify. So by looking at it in terms of, are we getting the right job, the right equipment for the right job? The other thing is, have we invested that money in the right piece of machinery? Bigger equipment means more maintenance. And do we have the capability in terms of your team? Do they need more training to operate a bigger machine? You know, it might be more complex, it's more computerized. You might have to pull wider machinery. All these things actually create some problems. And that's a cost, because you have to train people to be able to do those things. So from a business perspective, look at how you invest your equipment. Going back to what I said before around that jetting machine, well, I invested a fair bit of money in that. I actually built it. It cost me about $13,000 at the time. This was back in the very early 90s. At the time, that was a fair bit of money. But when you looked at the efficiency improvement that we got from the spraying the animals, it well and truly, the benefits well and truly outweighed the cost. So that's where we need to look at how we're investing in improving the way we do business. Things like drones, computerization, all those things have an investment cost, but they should actually produce a benefit that's greater than the cost of inputs. Now, this is a calculator that I created a number of years ago. And what it does, it calculates effectively the size of machine per kilowatt that's required to farm 2,000 hectares. And what it does, it looks at all your inputs in terms of the cost of the machine, the expected life of the machine, repairs and maintenance. There's usually an algorithm based around that. And there's allocation in terms of what it does. Fuel is accounted for. In this particular case, I think I've got the fuel at $1.25. Obviously, that's a while back. But what it does, it then calculates the cost per hectare of that machine. So what I've gone and done in the next chart, I've calibrated that across a 400 kilowatt machine, a 300 kilowatt machine, a 186 kilowatt machine, a 125 kilowatt machine, and a 70 kilowatt machine. So what I basically said, what is the most cost-effective machine to buy to farm 2,000 hectares? Interestingly enough, it's this one here. So as you can see, surprisingly, once you get to the smaller machine, the cost goes up. And the most expensive machine per hectare is your 400 kilowatt machine. And that's because there's a high operational cost and a high holding cost, despite the fact that labour cost increases as the machine gets smaller, which is understandable because you're going to spend more hours driving it. Now, the interesting thing about this is fairly arbitrary. And as an economist, I'm making assumptions here. And I know that people laugh at economists because we make assumptions about all sorts of things. But the assumption is that everybody has the same desire to do something. So they have the same desire to get the minimum cost per hectare of operations. There are a number of other things that need to be taken into consideration. They're relatively subjective. One of them is you might want to drive around a paddock for 4 or 5 weeks planting. You might just want to do it in 2 weeks and go for 2 weeks holiday. Or if you're up north, maybe you want to go fishing. I know a lot of people enjoy going out and doing a bit of fishing. I'm not a fisherman, but I know a lot of people do. My son does. So the other one is in terms of risk. Now, a 2-week window of planting, because we know that, especially in wheat, a 3 to 4 week window is when you're going to get maximum yield for your particular variety. So if you extend beyond that, then your yields start dropping off. So if you're looking at a 4-week window and that 125 kilowatt machine looks at being able to cover that country over about a 3.5 week period. So when you're looking at that, so what is the risk of rain? Because if it's going to rain for 2 weeks and you're halfway through your planting, that means for 2 weeks and then probably 3 or 4 weeks, then your window of opportunity is going to decline very rapidly in terms of yield. So there's a risk associated with it. So when you start looking at this in terms of pure value, those might not necessarily be your real values. They might not necessarily be your real aspirations. You might want a bit of time, you might want to reduce risk, So again, considering all that, the choice, this allows you then to make a choice. And there are tools that we have available to us, such as decision tree mapping, which allows us to quantify some of that. And we can talk about that at a later date if there's an interest in it. So again, coming back to our management strategies finance. When we spend money, the first thing we should always do is do a cost benefit. Because if we're spending hundreds or thousands or millions of dollars on an asset, we need to make absolutely certain that we're going to get a return on that. So from a business perspective, do the cost benefit. So, and again, one of the webinars we talk about in the future is investment maximisation. And one of the topics we talk about there is in terms of cost benefit. Are we making the best use of our money? And an example of this is, do you have money tied up into overheads, overdrafts, as opposed to, say, a fully drawn advance or something like that? Because some of those things like overdrafts are higher interest. So are you maximising the use and the efficient use of that money? So maybe if you've got a high overdraft, maybe it's worthwhile considering it. And if it's embedded in the business, it's worthwhile considering saying, well, I'll get a fully drawn advance or some form of term loan to be able to reduce the interest cost and pay it off over time. We talk about capitalisation. Overcapitalisation generally reduces your return because there's an awful lot of cost tied up in either maintenance and or the cost of money that's diverted, or some cost which you can look at maximising your finance in other areas. And of course, there's the holding cost of things like your assets. Some assets you have to have, and some assets, do you really need it, or is it worthwhile getting a contractor to come in? They own the hold the asset, and it's their risk attached to the finance. So what else do we need to know? Of course, equipment usage. Coming back to the tractors that we spoke about, are we maximising that capital efficiency? Are we maximising the asset that we have available to us to produce the most amount of money that we need? Staff assignment. I've spent a number of years employing people. Do we give the right person the right job? Sometimes we might be pushed into a situation where we can't do anything else, but we need to know that people that are doing the job are able to complete it and function effectively. And I know, having operated a bulldozer in all sorts of forms, contract bulldozing, earthworks, stick raking, there are people who can do a better job. They're very skilled operators, but sometimes they'll rake 2 or 3 or 4 hectares more a day than another person who seems to be working really hard. And a good example of that, we had a team used to come to do crutching for us. And one guy looked to be working really, really hard. And he was only doing about 500 a day. Another guy that worked right next door to him looked as though he was cruising, and he was still only doing 500 a day. One guy put a lot of effort into it, but it wasn't achieving the same amount of output. Again, skill levels. I spoke there about operation skill levels, but also understanding the broader perspective of the business. So a good operator will actually reduce your risk because they can carry out their job more efficiently, but also they understand the risk and the direction that you want the business to go in. So it's really important that you consider that when it comes to looking at improving your productivity and performance. Now, as I said before, lost revenue is a cost. Lost revenue can be caused by a number of things. It can be low prices due to quality. For example, livestock not meeting expectations or specifications of customers. Lower breeding percentages. In other words, it might, your calving or your lambing percentage might be in the low 70s and 80s, whereas you would like it to be up to the high 80s and 90s. That's a cost, and you need to look at how you're going to improve that. So some examples of revenue loss. It might be soil compaction, soil nutrition, lack of rain. We can't control lack of rain, but we can control soil compaction and nutrition. It might be, excessive fertiliser can create problems within growth. It might be too much fertiliser. It might be not enough. In terms of genetics, I spoke about improving genetics with the sheep flock we had. It can be feed quality, gut nutrition. It can be low birth weights. A really good example of low birth weights. When I worked for a fairly big piggery for a while down in Armidale. Our weaner percentage was about 9.5 piglets per sow, due specifically to low birth weights because of methane gas. We reduced the impact of methane gas. That saved or increased the revenue of that particular piggery by about $600,000 a year, just by looking at changing the impact of methane. Of course, it can be damage such as insects or animals. quality control and production systems. They're all causes for revenue. Look at how you can improve it and say, okay, what can I do about that? Coming back to that frontier analysis, what do we need to do? How do we respond? Look at current resources, capability and capacity gap analysis in terms of our business, in terms of the capacity and capability of our operations and our machinery and our staff. Identify strategic development priorities. This comes with a lot of work because you've got to look to the future and say, okay, where do I want to be in 5, 10, 15, 20 years' time? And look at pushing the direction of the business in that and investing in that strategic priorities. When you develop your priorities, make absolutely certain you do a cost benefit. You have to be able to understand what the impact of you might be investing $2 or $3 or $4 or $5 or $10 million into your change. Are you going to get the money from that? Once you've got that, look at how to develop the program to implement it. And then the final part about that is the implementation. And this comes back around how you manage that implementation. And just a bit of a comment there. Improvement programs should be developed through an informed decision process as part of a commitment to continuous improvement. And that is really critical. We have to see where we want to be. So where to from here? The first one, where are we now? Do a situation analysis. Do the ratios. Map the processes. Look at what our current resource uses are. Once you've done that, once you've got the numbers on paper or in the computer, have a look at the results and see how they perform. Are you able to improve it? What sort of criteria do you determine to show as performance criteria that can be improved on? Really focus on business best practice. And this comes back to that DEA, that frontier analysis that I was talking about. We want to improve everybody to a point where we're all sitting at the 100% mark. Coming back to benchmarking, it comes back to that performance criteria. Peer-to-peer, comparing yourself to your neighbours is really important. Time series, if you're looking at doing things, how are you improving over time? Because if your trend in terms of your margins is going down, well, you've got a problem. Because at some point in time, your margins are going to be negative relative to your overheads. Establish some improvement KPIs. Look at what numbers do you want to change, and look at the best low-hanging fruit that you can do to achieve that. Address those high priority concerns, those ones that are going to have a real impact. Look at easy wins. It's a really important part to do because easy wins gives you confidence, and you're always happy about you've got an easy win. An easy win might be, okay, well, I'll fix that fence up, or I'll put a new paddock here, which means it's easy to muster, or put a laneway in. We've set up a series of laneways on the property out west. It used to take us 3 months a year mustering cattle. We shifted that to 1 day with a helicopter, only because we had a laneways. So yes, it took a bit of time, but they were easy wins. Look at the cost benefit, and I can't stress enough, do the cost analysis. And looking at your strategies, and this comes back to putting it on paper. And you need your strategies. Your strategic planning doesn't have to be a war and peace. 15 or 20. I'd see strategic planning as 2 or 3 page document. What are you going to do? What's it going to cost you? And what is your growth strategy embedded upon that? Okay, well, thank you very much for that. I hope that it made some sense. Remembering that this is very high level. Normally, this sort of topic is covered in a number of university degrees. I did 3 or 4 of them when I studied for my undergrad and my master's degree in terms of managing cost. So it's a topic which is very broad and it can be very, very targeted. So if you have an interest in looking to expand some of those topics, you'll get a copy of the presentation once we finish up here. You can have a look and say, okay, well, I would like to explore this or something else. Let us know in the feedback forms that we've got. We'll have a QR code at the bottom of it, at the end here. Click on it, give us some feedback, and really show us whether there's any topics that you would like us to expand on. So here is our contact details. Again, you'll be getting a copy of the presentation. So our contact details are there. Do not hesitate to drop us a line. All our emails are there, and also our phone numbers. And lastly, and I'll leave this up for a while while we do the Q&A, just use that. If you've got your phone near you, just click on it and provide us with feedback. Feedback's really important for a number of reasons. One is it enables us to look at how we can help you in the future. to look at some webinars or workshops that you would particularly like us to pursue. But also, as a presenter and as a content writer, I always like to get feedback on whether I'm actually getting the message across. Am I being too complex or complicated? And also just general feedback on what you thought of the webinar. Did it hit the market, hit the nail on the head, or head of the nail, or whatever you want to call it? But yeah, just to make sure that we're actually meeting your needs, and it's really important that we get that. So I'll hand it back over to you, Dan.
Yeah, great. Thanks, John. And yeah, I suppose you've covered a lot of content there and some complexity around it. So I'm hoping, yeah, if people have got some questions, please put them in, and yeah, we'll go from there. But probably just to start off the question time, John, I really like that graph when it comes down to the comparison of machinery, and probably really triggered probably the idea of lost revenue for me when looking at risk. So on that machinery comparison slide, I might even just share it with everyone.
I might have hasn't got my squiggles on
it. Yeah, this one's a bit cleaner. Like obviously you've crunched the numbers. The 125 kilowatt tractor is the most efficient and effective. Though this is a bit of a rabbit hole, but how do I factor in that risk or possibility of loss when we're looking at that lost revenue, in my decision making? Because like you probably touched on, I can get the job done in 4 days with a 400 kilowatt machine, or I can get it done in 4 weeks, with a 70 or 125 kilowatt tractor.
It's a complex topic, because again, what I said before, economists have this perception that we just assume that everybody's got the same needs and wants. But as you quite rightly pointed out, there are a whole host of other variables which we don't take into consideration. We just said, well, the really good thing about this chart here is it says this is what is the best that you can do based upon the cheapest per hectare. But that doesn't take into consideration, as Dan said, the loss of revenue if, for example, your planting time is pushed out, or that you can't get onto your country to work it, and it doesn't allow it, say, to the vegetation matter to decompose enough, and you have a nitrogen problem when you come to plant. So again, these are things that you can look at, and there are methodologies that you can use to be able to determine that and calculate it. For example, I mentioned before a decision tree, and what it does, it then allocates a probability of that event occurring. So you might say, okay, what's the probability of excessive rain when we're cultivating or excessive rain when we're planting at that particular time? And you can work that out by going over your rainfall records when you're looking at the specific time that you want to plant, and say, okay, well, in the last 100 years, we've had this amount of rain at this particular time of the year. And then you can say, well, what does the rain look like? Is it big falls or little falls? So you can say, okay, well, then you can start working out the probability of that occurring, and then you can determine the impact upon that on the revenue. And that's a risk process. It's very much about allocating risk to it. Another one that we can look at is, okay, well, yes, I want to buy a bigger piece of machinery, because it means that I can go contracting. So I can then go, I can do it in 2 weeks, do my property in 4 or 5 days, then I can go and farm everybody else's. But you have to remember that there are other people out there doing that as well. But also, if, for example, you've been rained on and you've lost the time, you've still got to get and plant that crop, and everybody else wants to do it at exactly the same time. So while you're doing yours, then the other people are also doing theirs. So they're probably thinking the same sort of thing. So you need to consider that when it comes back to investment and risk, and I suppose potential opportunities. And you can do that through some form of scenario analysis. You can do a very, very simple partial budget. And again, we're looking at that sometime in the near future around doing an investment maximisation webinar. So what does that look like? What's the benefit? You can do some comparisons between the two. So it's about personal, and what I said before, you might just want to do 4 or 5 days of your planting and then go away for holiday. That's your choice. So, and again, I gave that example that I spoke about down in Armidale. The best operation that they had was sheep, believe it or not, but they didn't like sheep because they took up too much of their time, and they ended up going to cattle. While the margins were less, it meant they had more time to do the things they wanted to do from a leisure perspective. So again, that's a way up. I gave them the numbers, but then it's their choice to say, okay, well, this is what I want to do. So again, some of that's subjective and some of it can be analytical. Does that answer the question?
Yeah, no, that's great. Thanks, John. And I think we probably can go a bit more into it in future webinars as well. But I do have a question here. A person is looking into building these analysis sheets, and do you have any references that you could provide to be able to start building these personally?
Some of the references are available from online. You might be able to pick them up. Like some of the data comes just as raw PDF documents. So if you looked at that, and when you get the presentation, you can see some of the charts there, and some of the draft things like the requirement for heavy chiseling or farrowing or planting relative to the soil type. It'll actually give you draft requirements. And then it can be allocated to horsepower requirements, which looks at fuel usage. So you can actually, it is possible to do it. In some particular circumstances, you might be able to talk to your agronomist if you're looking at a machinery table like that and ask them to be able to build one for you, because it is out there in the public domain. It's I built that one there about probably 15 years ago, so it's been around a while. And some of the early work that you might have seen there was in horsepower, because we weren't talking about kilowatts back then. But yes, it is possible. Certainly do the research, things like the litres per horsepower relative to equipment. Again, you can do the research on that. And one thing that could be worthwhile you're investigating this day and age with our chat AI, artificial intelligence, sometimes you can actually create some of these tables from AI. I've done a bit of this in the past, but just recently, around creating tables. You probably need some support to do that, because you need to ask the right question, but it is possible to create these tables.
Another question, John, just around the calculation of wages, just states here, it's easy to put a value on employees, but what is the value that could be allocated for unpaid staff? So in the example of owners.
So to make it relatively simple, if you want to put it that way, it's not really simple. So what I tend to do with owners is I look at the some of your employment guidelines, some of your labour statistics and numbers, and look at what that skill level would be paid at. And then if it's a managerial role, so for example, you might be a very skilled operator in machinery and all that sort of thing, and you'll see what the hourly rate is on that. But then on top of that, there's a managerial skill which is required as part of that. So you can add a premium to the base level. So as an operator and as an owner operator, you'll be able to judge your skills relatively well compared to what is deemed to be a standard for that particular industry. And then you can say, okay, well, I need to pay myself an extra 20% on that, or 30%, and then you can then allocate yourself as a wage. Alternatively, the other way you can do it is you can say, okay, well, the average wage being paid for a manager in the cattle industry in Queensland is $82,000 a year. That's found. So you can say, okay, well, that's that plus that's sort of a base wage plus the food, board and keep, possibly telephone, and maybe a vehicle. So you can say, okay, well, that's what the value of that labour is, and that's an alternative method to do. In terms of real impact, I still go back to the wage classification, because that's more prescriptive, because you're actually comparing yourself with your staff.
Right. Just another quick question. just around being able to obtain a copy of your DEA efficiency machinery spreadsheet. John, I can probably talk to you directly after the webinar around that. But yeah, some of these spreadsheets, John, like there's a bit of complexity around them too. So, and I suppose some of the age of them is in your capacity to share.
Yeah. Look, just on that, we're looking at doing a pilot on doing some DA efficiency stuff, or frontier efficiency, as I like to call it now. But for that to work, we need a group of people who are of like-minded, are prepared to share their data, and I can run it through our machine, our software, to create that table, which looks at the improvement over time. But also, you should be able to talk to your financial advisor and your business consultant to see if they have access to that sort of software. But the really was that work that I showed you came directly from profit efficiency. This efficiency divided up into profit and operational or allocation. I like to see allocation efficiency as well, because that determines the amount of kilos of inputs that you use, for example, fertilizer, relative to the kilos or tons of output. And that really looks at efficiency. So, and that's what I said about capturing that data at the front end. It allows you then to really drill down into just exactly what your performance is relative to your inputs. Can I get the same performance from, say, half a tonne per hectare of fertilizer? Less.
We're just probably coming to the end of final questions. I'll just give people probably one more chance to put one in. But while we're waiting, John, when it came to your decision around the sheep jetting, like I suppose at what rate of return, or like there's a lot of questions around there around your own cost as an owner in completing the tasks, building the equipment, but what sort of rate of return were you chasing, and what did it actually end up with? Like was there a bit of you had an idea in your head about what you were trying to achieve there?
I've got to be honest here. It was way back before my time as a real business and analyst and economist. So what I was looking at, I understood two things. One thing that I looked at was the amount of effort it took us to get through our whole flock and the time it took, knowing that we had losses attached to that. So I didn't want to reduce the losses. And the second one was around the labour efficiency that I was looking for. And we were able to put through, being exposed to the early automatic jetting machines, we were exposed to putting large volumes of sheep through in a day. And the problem that I found with all of those was that we had no consistency in material or spray. And that was the problem that I saw then. We were able to improve the efficiency of throughput, but we weren't able to improve the efficiency of application. And hence the reason why I went down the pathway of inventing our own machine, which enabled us to combine the two. So effectively, those sheep went through a spray race on a conveyor belt. So they was, as they went on the conveyor belt, they went through at exactly the same space all the time, and all we had to do was just put the sheep on the conveyor belt, and they went through a foot and a half apart at a constant rate. So we were able to then manage the application. So every single sheep got 0.5 or 1.5 or 2 litres of water on it. Exactly the same application. So I was looking at a combination of both. One was improve the efficiency of application, but also improve the throughput. So we already had the throughput by the other machines we had, but we didn't have the application efficiency.
That's great. Well, look, thanks very much, John. And I think we might look to end there. I don't see any more questions in the chat, but yeah, there's been a really big interest in the recording, so we'll definitely be sending that out after the event. And if you have any further questions, yeah, please feel free to reach out to John or Claudia or myself. And the email address that the invites come out on should be the one you can get us all on as well. So that in mind, thanks very much, and hopefully we'll see you all next time.
And if you're interested, just check on that QR code to give us plenty of feedback. So if you're interested, we can send out the QR code for you to click on and give us that feedback. It's really important to us. And thank you for attending. I enjoy doing these events, and I hope that what we provide is beneficial to everybody.
Great. Thanks very much.
Thank you.
See you all later.